earnings-based valuation, net income-based valuation. So, talked about free cash flows, we've talked about dividends. Today, we'll talk about earnings, net income, accounting-based valuation. A lot of it is very similar to what we've done already. It just takes a somewhat different perspective. So the dividends-based approach focused on what is really being distributed to shareholders. The cash-based approach is what is available to be distributed to shareholders. And the earnings-based approach is what wealth are we creating that ultimately could be distributed to shareholders. This is the wealth creation one. Probably furthest removed from what shareholders are really getting, but in some ways the best. It's not necessarily the worst way by any stretch. And in fact, if done right, all three ways will give you a similar, if not the same, valuation. Let's talk about earnings. It's the single most widely followed measure of performance. We all know that, right? Earnings announcements come out, and the markets go crazy. As they try to say, did they beat analyst expectations? Did they trail analyst expectations? So earnings are important because people watch them. It's based on accrual accounting, not cash-based. It's often released before the reports. 10-Ks actually come out as the information has been calculated and verified. It comes out. And analysts, what they do is they build models to try to forecast what they believe earnings will be. Because once you know earnings, using P/E ratios or whatever they choose to do, you can take those earnings and convert it into a valuation, either market-based or valuation-based. And we know that companies make their money by selling research that leads to earning expectations. We know that markets move based upon earnings. And we know that every company has to report by law earnings per share. So those all make it a viable way to value a company. So if we think about earnings, it measures wealth creation for the shareholders. And once again, we use the same basic formula we've been using. Now, because of accrual accounting, the wealth creation might be timed a little bit differently than when the cash is really available to give to shareholders, but over the life of a company, that should all shake itself out, and accrual accounting over the life of a company should match actual cash. It's still, it's actually in some ways, oops. As we said, it self-corrects over time. Unfortunately, as we know, accrual accounting is open to manipulation. Cash is cash is cash is cash. It's hard to manipulate how much you have. The dividends you paid are what you've actually paid. You can't manipulate that. But accrual accounting could be manipulated either illegally or legally to make it look better or worse than reality. So as an analyst, your job is to carefully consider whether or not it's possible that it has been manipulated. Now this is interesting. Even with its imperfections, earnings more closely match wealth creation in a given period than cash flow. Because if you think about cash flow, you could, in a given period, do a new financing, get a dramatic amount of cash flow in a given period. That really has nothing to do with wealth creation. You just borrowed someone else's money. Right? So cash flows don't necessarily match how well the company is doing in a given period. While earnings, because it's accrual-based and accounting-based, may be off, they might still, or are still, more appropriate than cash flows in some ways. So this is the earnings-based. Now, it's a good time to take a break. We think of net income, and that includes all income items. We're going to talk about something called residual income. Residual income as the basis for our earnings analysis. Residual income. Anybody remember hearing this term somewhere in your past, residual income? You do? Cost accounting, management accounting, you may have. When companies are not valuing now, but they're trying to decide whether to go ahead with a product or a new division or a new project, quite often they'll use ROA, return on assets, to determine whether a project is a worthy project. ROA. The problem with ROA in that regard is, let's say a division normally has a 25% return on assets. The company demands a 15% return. That would be the division, and this is the company as a whole. And a project is out there for this division to take on, which is 20% return on assets. Okay? That division would potentially turn down that new project because it would reduce their return on assets as a division as a whole. And if the manager is getting somehow compensated on return on assets, they'd say, no, we're not going to do that, even though it is better than what the company demands. So your best divisions may not do some projects that aren't up to their normal standards. That's the limitation of return on assets. So some companies, as they look at the same project, looks at something called residual income. That is the expected income flow from that project minus, so it's your net income minus the required income. Net income minus required income. Okay? And that required income is based upon your discount rate. So if you're going to invest $1 million and your discount rate is 10%, you're saying, we're not making money unless we make more than 10%. So if your net income, let's say, was $150,000, and your discount and your investment was $1 million, and your discount rate was 10%, you'd have 150,000 minus 100,000. So your residual income would be $50,000. $50,000. And any time your residual income is above zero, that's a good project. That's saying that you're making more money than required. And anytime it's less than zero, you wouldn't do a project because you're making less money than required. So that's what how it's done inside of the company. That's where you might have seen the term residual income before. The same exact concept is the concept we're going to talk about as it relates to valuation. You value a company based upon its ability in the future to deliver more income than required for future years, for forecasted years. Let's go through it now. That's the background. So we'll use all income items when we look at that. Yes.
Question about that. The residual income, does that refer to the $50,000 that was left over at the time, or is that?
This is the residual income, bottom line.
Is that discounted to today, or?
Yeah. Yes. Yeah. Yes. So this could be this is a net income flow over time, all discounted. I simplified it here.
Okay. So the $50,000, when it's earned, it's going to be regular income, but when you discount it, that's when it's called residual income?
This $50,000 as it's earned
Yeah.
is essentially the increase in value of the company
Yeah.
from that income over time.
So why is it why is it called residual income instead of just regular income?
It's the residual of your net income minus your required income. It's the residual, what's left.
Okay.
Your required income being
ROA.
your no.
The 25%, wouldn't that be like?
This is ROA. Leave this aside now.
Okay.
This is residual income. The required income is your investment times your discount rate. Investment, in this case, times your discount.
Oh, I get it.
Okay.
I got it.
The discount rate, the required rate of return.
All right.
So, net income includes everything, including other comprehensive income. We did this when we did the dividend model. Book value this year is equal to last year's book value plus income earned minus payouts to shareholders. This is being going into retained earnings. We reorganized it to determine what dividends are equal to. Just reorganizing that equation. We're going to focus on this side of the equation now. Do that again. Okay, so here's our dividend valuation model. This is our residual income valuation model. Let's take a look at it. All we've done, I've taken a couple of steps out of here. I'd have to show you the derivation. We took that previous formula from the previous slide and replaced dividends with book value year 0, book value year -1, and net income. Okay? So this is just the derivation from that. And it says your value today is equal to your book value today from your account, from your balance sheet, plus the sum of your residual incomes discounted. That's what you were asking over here. It's equal to your current book value plus the sum of your residual income, so it's your net income, accounting net income, each year, minus your required return, which is your discount rate, times your book value from the previous year. That's what you needed to get, and then the discount factor, and that's for perpetuity. So if you're not adding any value, if you're just getting returns equal to your required rate of return, your value is equal to your book value. If you're getting better returns, you're increasing your value. If you're not meeting that need, you're decreasing your value. Bless you. I think this is what we just said. Book value plus your income that would have been expected. And that's your residual income discounted over time. Of course, you can't do that for perpetuity. So we're going to have to figure out the continuing value shortly. So this residual income is also, you can think of it as an economic earnings or an abnormal earnings. It's what you're able to do more than what's required, or less than what's required. And as I said, it measures your wealth creation. I think we've done all this. And of course, you need a continuing value. So we'll do this for only a certain number of years, 5 years, let's say. Our continuing value, this is coming from that original plan. So this is saying in year 6, we're just going to take our value from year 5 and apply a growth rate to it. 3%, 4%, 5%, whatever you all think is your growth rate. And that'll be our net income in year 6. Subtracting out the required income in year 6. So this is our year 6 residual income, assuming it's a steady state growth at that point. We then use the perpetuity factor here, 1 over required minus growth, excuse me. That's the perpetuity factor. And then you discount the perpetuity factor back to year 0. This is discount back to year 0. So this is the valuation based upon residual income, including the continuing value. This is the overall equation.
T is year 5.
What's that?
T is year 5.
T in our, the way we're going to do it is 5 years. That's right. Year 5. Okay, so we do this the way we do anything else. We'll have to forecast our net income for each period going forward. We'll have to forecast our book value going forward. We know how to do that. Chapter 10 kind of stuff. We have to calculate our future income, required income, based upon the book values and our discount rate, and then we subtract it. So how is this similar? How do we treat this similarly to the original model, the dividend model? We use CAPM. Don't care about inflation. The growth rate has to be less than the discount rate, both logically and mathematically. We're going to forecast for 5 years. Whoops. You should do the mid-year adjustment at the end. And sensitivity analysis. Finally, let's take a look at sensitivity analysis. Same idea should be used in any of your analyses. This was for Pepsi. Pepsi was assuming long-term growth of 3% and a discount rate of 7.75%. And at the time of the writing of our book, that came up to a stock value of $57.36 a share. I think at that time the price of Pepsi was like $51. So based upon that, that point estimate, it says buy. But you know, is 3% real? Is 7.75 real? They're just assumptions. So you would create a, potentially, you may not have to do all of this, but it's a good idea to do some of this, a matrix to understand how sensitive are your results to different growth rates and different discount rates. Notice we have the NAs over here, and we want to venture a guess why these are NA? Not applicable?
Your discount rate shouldn't increase by the long-term assumption.
You're on the right track.
The value shouldn't be greater than.
Yeah.
Did it say that?
The value shouldn't be greater than the.
In these cases, your growth rate is greater than your discount rate, which doesn't work. Doesn't make sense. But let's see what does make sense. So we know that the stock price is $51 a share. Let's see where that holds. No growth and a 6% discount rate. So it holds for a pretty good set of numbers here, but it's not compelling. You get to make the judgment. Does it hold enough based upon what's realistic in the real world to say we should buy the stock, without point estimate of 57? Some of these numbers down here, 20% discount rates and things like that are probably not realistic, so you can discount them completely, just take them out. So this is what a sensitivity analysis does. It allows you to focus on your point estimate and then focus around it, maybe in here, and say, does it still look like a buy signal with other available reasonable values?
Did you say this is optional for projects?
Everything's optional.
I just recall you saying it was optional.
Is it optional? I can't answer that. Confuse you. I can't. Listen, it's like everything. Is it the first thing you should do? Probably not. Is it towards the end? Probably. Does it make for a more compelling presentation? Probably. So, if you're choosing to be compelling, I know you want an answer.
No, I thought I heard you say before you don't have to do sensitivity
No,
analysis,
okay.
so I'm following up.
So you don't have to. But if you're looking to be more compelling, this will make it more compelling.
Where are you getting all these rates and numbers? Or where are you getting all the numbers from?
These numbers?
Yeah.
Well, they wrote the book, so they got to redo redo the analyses over and over again. Now, in FSAP, how hard is it to change the growth rate?
It's really complex.
To change the growth rate?
No.
Don't you just plug it in once and everything gets shot out?
Yeah.
And same thing with the discount rate. So you do everything. I might be wrong on that. I don't want to oversimplify it. Tell me if I'm wrong. So you do everything once. You do it for your point estimate, and then towards the end say, hey, let's take a look around that point estimate, and let's just change a couple of variables and see what it would have been. That's all. I don't think it's, because of FSAP, I don't think it's a crazy amount of work. If it is, don't do it. Don't do it if you have to redo everything over and over and over again. It's just putting in a couple of variables, hitting enter, letting it hash out an answer. And don't do it for whatever this is, 200 different values. That's crazy.
I was gonna say.
No, just do right around your point. Your point estimate is what you believe is your best estimate. Do right around it.
What I wanted to mention is because even we, in our case, like they gave us 2 scenarios with growth rate and discount rate. Like you could do like 3 or 4 scenarios, and there will still be it'll be volatile, the results, because 1% increase or decrease in the growth rate and the discount rate is going to give you several different results. You know what I mean? So you can do a sensitivity analysis like that. Doesn't necessarily have to be like this either.
Yeah. So this is
Oh,
overkill.
there it is.
I believe this is overkill. Nobody needs to do all of this. Did I answer your question, Jackie?
Yeah, I just wanted clarity since
Okay.
that's, yeah, there's, might require some formula recalculations, but
In what way?
perhaps I was just asking.
Okay, it does. Implementation issue. So we talk about something called clean surplus accounting. When you look at the other comprehensive income, which is included in net income, you might want to discount certain aspects of it. Unrealized gains and losses on investment securities, that's considered dirty surplus. Foreign exchange gains and losses. Pension liability adjustments and cash flow hedges, excuse me. And you can find that information as necessary in your notes. But you also need to think about whether the net income is truly available to common shareholders. If they're preferred shareholders, you need to subtract out their dividends, because that's not available. That's not net income for common shareholders. And if you have a subsidiary that you're not 100% owner of, you only take the percentage that you actually own of their income. So the advantages and disadvantages of this model. The world thinks about earnings. So you might have a value of earnings. That's an advantage. It's probably easier to do than free cash flow valuation. And less up to management discretion than dividend calculations. It's a little bit further removed from what the shareholders actually get than dividends or free cash flows. And if you don't do the appropriate amendments, adjustments to the financial statements, you run the risk of not truly affecting or not truly reflecting economic value. You need to do the adjustments. If there are one-time costs or one-time value being added, and if you don't adjust for those things, then earnings will be inappropriately high or inappropriately low going forward.